Now let's consider how management fees uh, can erode mutual fund returns. The management fee can definitely eat into the eventual returns you will obtain from your mutual fund investments. So we need to ask ourselves what exactly are management fees. What are management fees? So management fees are charges paid to the fund management team for their expertise in selecting and managing the portfolio's investments. And these fees are typically expressed as a percentage of the fund's asset under management and are included in the fund's expense ratio. They're included in the fund's expense ratio. That is it. So usually the higher the expense ratio, the more a percentage of your return will evaporate as fees. So when you want to invest in a mutual fund, you have to consider its management fees, its expense ratio. So we want to look at common components uh, of management fees. What and what constitute management fees? What are the components of management fees? Number one is investment advisory fees. Investment advisory fees. This is a kind of compensation the fund managers charge for making investment decisions on your behalf. They charge you this amount of money for helping you to manage your money. So number two is the administrative costs. This covers operational expenses like record keeping, customer service and regulatory compliance. These are what goes into administrative costs. They equally pay their employees also. Number three is distributions to marketing fees. So it is used for marketing, advertising, and distribution of the fund shares. If you look at your maybe investment apps or you are on browsing the internet, you come across adverts from different mutual funds. So these marketing fees or distribution fees covers, takes care of those adverts. So we want to see how management fees impact performance. How does management fees how do management fees impact the performance of a typical mutual fund? Number one is the reduction in return. The obvious impact here is a reduction in returns. So higher management fees reduces the net returns investors receive. If, for example, let's take a typical example. If a fund earns an annual return of 7%, all right, and has a 1.5% management fees. So in that case, the net return is 7 minus 1.5. And that will give you what? It will give you 5.5%. So over time, this reduction can significantly impact wealth accumulation due to compounding. It will impact wealth accumulation due to compounding. Number two is lower performance in actively managed funds. Lower performance in actively managed funds. So actively managed funds generally have higher fees than passively managed funds. I've discussed this in one of my videos. So, so passively managed funds like index funds, they charge minimal, level of fees. While the goal of active management is to outperform the market, many active managed funds, fail to consistently outperform the market due to, the fees they charge. They hardly outperform after fees. This may lead to underperformance compared to lower cost alternative like index funds. Number three is compounding effects over time. Compounding effects over time. So even small differences in management fees can have a large impacts, over the long term. For example, let's take an example here. Let's say fund A has a 0.5% fee. All right, fund A has a 0.5% fees, and it equally have let's say 10,000 initial investments, and it accumulates 7% annual returns. That's for fund A. Fund A, the fees is 0.5%, and the investments there is $10,000, and the annual return is 7% for fund A. Let's now consider fund B. Fund B has 1.5% fees, the same $10,000 initial investment, and 7% annual returns. And then over 20 years, the difference in fees, could lead to fund A outperforming fund B by thousands of dollars. So when you accumulate the differences in fees, over that number of years, it will amount to thousands of dollars. Okay. So example of impact of fees over time. We have an initial investment of $10,000, an annual return of 7% for fund A, and the fees is 0.5%. For fund B, the fees, as I earlier stated, is 1.5%. The initial capital is the same $10,000. So over 20 years, fund A will have a return of $33,000 while fund B will have $26,807 cents. So the higher fees reduces the final balance by over $6,000. You can imagine that's the difference between fund A and B. Look at the differences, as much as $6,000. $6,000 is more than 10 million naira. It's more than 10 million naira. So how do you balance fees and performance now? Balancing fees and performance. Number one is that you evaluate expense ratios. Look for funds with competitive fees compared to their peers. Some funds charge a lower expense ratio, and some other funds charge them a higher expense ratio. Number two, assess fund performance. Assess fund performance. So compare historical returns, net of fees, to ensure that the fund justify its cost. So you compare the historical returns, net of fees, to see how the fund performs or performed compared to other funds. Number three is consider index funds. For cost-conscious investors, index funds often have a lower fees and consistent track record. On track records, it tracks the benchmark, and if the market does very well, index funds will perform well. And if the market plummets, the index funds will equally plummet because their performance is tied to the performance of the index they are tracking. Number 4 is you watch for hidden fees. Look at those fine prints very well. So beware of any additional fees such as sales, loot, or redemption fees, which can further reduce returns. You look for, sales, loot, or redemption fees that would likely eat into the returns of the fund. So in conclusion, management fees have a direct impact on a mutual fund performance, especially over the long term. So high fees can erode returns, making it crucial for investors to assess whether the potentials for outperformance justifies the cost. By understanding and minimizing fees, investors can improve their chances of achieving their financial goals. Please subscribe to this channel and like this videos.